Hi, everyone. We are going to review a few problems at the end of Chapter 10 to get you into the termination and liquidation of a partnership. So we're going to look at number 25, number 27, and number 28. So in number 25, on page 510 of your book, the partnership of Hendrick, Mitchum, and Redding, and I'm going to scroll down here so we're not looking at all the answers. The following account balances. So they have cash and they have non-cash assets. They have some liabilities, and then their respective capital balances are presented. This partnership is being liquidated, so it's shutting down. Hendrick and Mitchum are each entitled to 40% of all profits and losses, with the remaining 20% going to Redding. Notice Redding's capital balance is negative. What is the maximum amount that Redding might have to contribute to this partnership because of the deficit balance? Well, we just don't look and go $15,000, because there's still a chance that the non-cash assets may be sold for zero. So we take worst case scenario here and we say, okay, if they sell the non-cash assets for no money, there'll be a $135,000 loss, 20% of which will be allocated to Redding. So his deficit balance because of this loss will go from $15,000, 20% of 135 is $27,000. So the maximum loss that could be in his account, $42,000. And that would require him to contribute $42,000 into the partnership to rectify that negative capital balance. In Part B, how should that $20,000 in cash that is presently available, that's above liabilities, because there's cash of 50, liabilities of 30, be distributed? Well, all $20,000 should go to Hendrick. Let's see why. As Hendrick and Mitchum view the current situation, the maximum potential total losses would be $135,000 if they didn't sell the cash assets for anything, and the $15,000 deficit in Redding's account. So if they had to allocate that $150,000 loss between them, their profit and loss ratios are 40% and 40%. So 4 to 4, really, one would get half of the loss. So Hendricks would have to absorb half of the maximum $150,000 loss, and Mitchum would have to absorb $75,000, or half of the loss. Right now, Mitchum's capital balance is at $70,000. If he absorbs the loss of $75,000, he's now in a negative capital balance as well. So Hendricks would have a positive capital balance. So since such a loss would entirely eliminate Mitchum's capital account, only Hendricks has a safe capital balance at the current time. So if we were distributing that cash right now, Hendricks should receive all of it. So we're looking at right now. So if those assets are sold for more than zero, and if Redding's able to rectify that negative capital balance, well, things would be a little bit different. But if somebody wanted that cash today, it would be Hendricks. The final question in number 25 is, if the non-cash assets are sold for a total of $50,000, what is the minimum amount of cash that Hendrick could receive? Okay, so let's take this one step at a time. The non-cash assets book value are $135,000. If they were sold for $50,000, the cash would go up $50,000, but there would also be a loss on the sale of $85,000. That loss would be allocated to each partner's capital account based on their profit and loss ratio. So Hendricks would absorb 40% of the $85,000 loss. So that would reduce his capital account to $66,000. Mitchum would absorb 40% of the $85,000 loss. Currently has a balance of $70,000 in capital. So his balance would go down to $36,000, and Redding has to absorb 20% of the $85,000 loss, which he already has a deficit balance. So his deficit would increase to $32,000. The next step is to absorb Redding's deficit balance between Hendrick and Mitchum. And since they share in profits 4-4, half of the $32,000 deficit of Redding would be allocated to Hendrick. So Hendrick's account would decrease another $16,000, and so would Mitchum's. So Hendrick's balance would be $50,000, Mitchum $20,000. So if the non-cash assets are sold for $50,000, there would be, if we added the $50,000 to the current cash, it would be $100,000, but then pay off the $30,000 in liabilities, there would be $70,000 of cash. $50,000 would go to Hendrick, $20,000 to Mitchum. And that's how we determine who gets what during liquidation when we have these kind of unique situations. Let's go to 27. March, April, and May have been in partnership for a number of years. The partners allocate profit and losses on a 2, 3, 1 basis respectively. Recently, each partner has become personally insolvent, and thus the partners have decided to liquidate the business in hopes of remedying their personal financial problems. As of September 1st, the partnership balance sheet is as follows. So they have cash, accounts receivable, inventory. So now we're giving you specific assets, specific liabilities, and their capital balances. So we need to prepare the journal entries for the following transactions. The company sold all the inventory for $56,000 cash. Oops, that's 26. Let's get to 27. There we go. So we'll debit cash for $56,000, credit inventory for $74,000. So they sold it at a loss of $18,000. Well, that loss needs to be allocated to each partner based on their profit and loss ratio. 2 to 3 to 1. 2 plus 3 plus 1 is 6. So 2/6 would be allocated to March, or $6,000. 3/6 of the $18,000 loss, or 1/2 of it, would be allocated to April's capital account, and then May would receive 1/6, or $3,000. So their capital accounts are decreased for their respective share of the loss. In Part B, they paid $7,500 in liquidation expenses. Again, credit cash. We don't have any revenue and expense accounts anymore. We're in liquidation. So any gains or losses are allocated directly to the capital account balances or expenses. So 2/6 of the expense is allocated to March's capital, so you'll debit that. April's will receive 3/6 of it, or reduce their capital account for that amount, as well as May's 1/6 of the $7,500. Paid $40,000 of the partnership's liabilities. Well, that's debit the liabilities, credit cash. There's no gain or loss here. Collected $45,000 of the accounts receivables. Just like you would any other time, debit cash, credit accounts receivables. Now, at this point, the company said, let's distribute some of the cash out to the partners. They may need it to remedy some of their personal situations. So it says, distribute safe cash balances. The partners anticipate no further liquidation expenses. All right. So what we need to do is determine each partner's capital balance. Okay, so we're looking at all of our journal entries there. Let's look at March. March starts with a $25,000 capital balance. We debited their capital for $6,000 in journal entry A, so you're reducing it for $2,500 in the second journal entry. So their current capital balance is at $16,500. Do the same thing for April. April's balance before these transactions starts at $75,000, but we're going to reduce it for the sale of the inventory loss of $9,000 and also reduce it for $3,750 from the liquidation expenses. So they're at a $62,250 loss. And then you would do the same with May, starting with a $46,000 capital balance before these transactions, and then reducing their capital balance for the $3,000 and the $1,250 from our first two journal entries, $41,750. So that's our starting point. Now, the next thing we want to do is determine what is the maximum loss that could occur. Okay, so what's the maximum amount of losses that could occur? Well, right now, we have $84,000 in accounts receivables minus the $45,000 that was collected. So the first thing is we may lose $39,000 $39,000 in accounts receivables if we don't collect that. The other asset that's still remaining is the $38,000 in land, building, and equipment. So our maximum loss on that is $38,000. So the maximum loss overall that still may occur, this is it, is $77,000. So let's allocate that as if it happened. 2/6 of the loss would be allocated to March. 3/6 of that potential loss, $77,000, is allocated to April, and then May would be receiving 1/6. So after that loss, what's left in each partner's capital balance? Well, March would have a deficit of $91,670, April $23,750, and May $28,917. Before we could allocate or determine a safe balance, what we would need to do is allocate the deficit of March to April and to May. So April's profit ratio is 3, right? And May's is 1. So 3 plus 1 is 4. So 3/4 of March's deficit will be allocated to April, and 1/4 will be allocated to May. So we'll reduce their capital balances. So as of right now, a safe amount of cash to give to April is $16,875, and a safe amount to give to May, $26,625. So we could pay April, and so when we do that, we will debit April's capital account because they're taking a withdrawal for the safe amount of $16,875, and May $26,625. So their capital balances would be reduced, and we would credit cash for the $43,500. Now, how do we get that? Well, we started with cash of $11,000. Let's go back up to our journal entries. We received $56,000. We paid out $7,500 and $40,000, and then we received $45,000. Okay, so we didn't pay out all of the $64,500, but just the safe amount that we could pay out right now, which would be the amounts we determined in the capital accounts. So let's keep going. Sold remaining accounts receivable for 30% of their face value. So their face value were $39,000, so we'll credit accounts receivable $39,000 times 0.3, 30%. We received cash of $11,700. The difference then, of course, would be a loss. So we take the difference of $27,300 and then allocate it to each capital account based on their profit and loss ratio. So March's capital will go down, April's and May's. Then we sold the land, building, and equipment for $17,000. Debit cash $17,000. Credit the land, building, and equipment for $38,000. So we have a $21,000 loss on this sale. Allocate that loss to each partner's capital account based on their profit and loss ratio. So 2/6 of the $21,000 will be allocated to March. 3/6, or half of it, will be allocated to April. Remember, losses decrease the capital account, so that's why we're debiting it. And then May's capital would be 1/6. In Part H, we paid all the remaining liabilities of the partnership. So let's just scroll back up here. We paid $40,000 of them up here. So of the $61,000, we're going to pay the remaining $21,000. So we'll debit liabilities, credit cash. Finally, distributed cash held by the business to the partners. Now, let's take a look and see where we stand. So March's capital is at $16,500. Remember, the other calculations here were just maximum loss, just to determine a safe payment. So March is at a $16,500 positive capital balance. Whoops, that was March, okay. We're going to decrease their capital to $9,100 for journal entry F, decrease it another $7,000 for journal entry G. So March can get $400 of cash out of the business. Let's look at April. April had a $62,250 capital balance. Now remember, April already took some money out. So subtract $16,875. Subtract their respective loss of the accounts receivables and the sale of the equipment. So they're entitled, whoa, I'm off a little bit. Let me see again. Try that again. I probably just put something in my calculator wrong. $62,250 minus $16,875 minus $13,650 minus $10,500. $21,225 is their capital balance, so that's the cash they get. And then we would do the last thing with May. May's current capital balance was $41,750 as of journal entry E. In journal entry E, though, they took out or withdrew $26,625 in cash through that safe payment. Then their capital account decreased for the receivables loss of $45.50, and then the loss on the sale of the equipment. So their current capital balance is $7,075. So they're getting all their capital balances. Since they're all positive, we debit each one, credit the cash. The partnership's books are now closed. There are no accounts left. And that's how you liquidate a partnership and calculate those safe harbor payments along the way. The final problem we're going to look at is number 28. Just check something very quickly. Sorry. Okay. And that is partnership of Win, Z, Yang, and Z has the following balance sheet. So Win, shares in profit and losses 50%, positive capital. Z, capital 30%, profit 84,000, positive balance. Yang is 10% sharing in profits, positive capital. And Z, same thing, 10%. Z is personally insolvent, and one of his creditors is considered suing the partnership for $10,000 that is currently owed. The creditor realizes that this litigation could result in partnership liquidation and does not wish to force such an extreme action unless Z is reasonably sure of obtaining at least $10,000 from liquidation. Determine the amount for which the partnership must sell the other assets to ensure that Z receives $10,000 from liquidation. Liquidation expenses are expected to be $30,000. So let's take a look. For Z to be able to pay his personal creditor $10,000 from the distribution of partnership property, the partnership's other assets must be sold for at least $86,000. Let's see. $96,000 in cash is needed to pay liabilities and liquidation expenses. So $66,000 in liabilities and liquidation expenses are expected to be $30,000. So they definitely need minimum $96,000 in cash. This is $56,000 more than the current cash balance. Based on the pre-distribution schedule below, the next $10,000 is received solely by Yang. The next $24,000 would be split 50-50 between Yang and Z. So let's take a look. The beginning capital balances are $100,000, $84,000, $50,000, and $40,000. If there is a loss of $200,000, okay? If there is a loss of $200,000, Win would absorb 50% of it because they share in 50% of the profits. Z, 60,000 of it. Okay, or 30% of 200,000. Yang, 20% or 10%, and then Z, 10%. Okay, so first of all, what's the assumed loss to reduce Win to 0? Now let's see what the next loss would be to reduce Z to 0's capital balance. Well, $40,000 loss because they share in profits 3, 1, and 1. So 3 over 5 times 40,000 would give us $24,000 to loss to zero out Z. So what loss would zero out Z? What loss would zero out Win? That's what we're doing here. Okay, so it would be a $40,000 loss. 3/5 of which would be 24,000 and would reduce Z to 0. What would happen to Yang and Z over that? Well, they would each be reduced by 8,000, or 1/5 and 1/5 of the $40,000. Okay. Now, what's the next balance? So, don't mind me. I'm just taking a look here because we're looking for Z. Yeah, we're trying to figure out Z. I'm going to take a time out here. Okay, sorry about that. So when we're determining this pre-distribution plan, again, we're looking to see who has the most vulnerable area for loss. So right now, Win, in order to zero out their capital, they're most vulnerable at $200,000 loss. Look at the other ones wouldn't zero out till loss was 280, 500 because of their profit and loss ratio. Z would be the next one who's most vulnerable because he would zero out at a $40,000 loss, where the others would, 30,000 is their current balance. They share in profit and loss 1/5. So they wouldn't zero out their 30,000 to the loss is 150,000 or Z is 100,000. So At $40,000 loss, Z's balance would be 0, and we would allocate the rest to Yang and Zed. The next level would be Zed being most vulnerable. He would be zeroed out at a $24,000 loss, where Yang would be zeroed out at $44,000. So the only one that would remain with a balance would be Yang. So how do we allocate our cash? Well, the current cash balance of $40,000 would go to pay off the liabilities. The next $56,000 in cash generated would pay off the remaining liabilities and the liquidation expenses. The next $10,000 will go to Yang, as determined. The next $24,000 will go to Yang and Zed, $12,000 each. The next $40,000 of loss there, would go to Z, Yang, and Zed, $24,000, $8,000, $8,000. And if there's any remaining cash after that, it would be split among the partners 5, 3, 1 to 1. So that's how you determine a pre-distribution plan. How much of the cash needs to go to each individual. So there would be enough for Zed to pay off his creditors. How much will be needed? As we said, $96,000 in cash is needed to pay off those liabilities. Okay, so based on the pre-distribution schedule, the next $10,000 is received. After that will be received just by Yang. Okay. Cash of $20,000 generated at this stage would provide Zed the $10,000 at the $24,000. Okay, but if we what's the minimum cash? Another $20,000. So we don't need $24,000 because he only needs $10,000 Zed to pay off his creditor. So if we're allocating, after we give Yang his 10, the next level on a one-to-one basis, we would need $10,000 for Zed. That would be $10,000 for Yang, so $20,000 more in cash. So 66 in liabilities, 30 in liquidation expenses. There's your $96,000. Then we would need $10,000 to pay off Yang, and $10,000 and $10,000 to pay Zed and Yang, another $20,000. So that would be $56,000 that we currently have, $10,000 and $20,000. Okay, so, well, $56,000 is how much more we would need to pay off the liabilities and the liquidation expenses. We currently have 40, we would need an additional 56. Then we would need 10,000 to pay Yang and another 20,000 for Yang and Zed to split based on this pre-distribution plan. Okay, so it gets kind of technical here, but that's how we would come up with how the money goes out, and you actually work backwards up this schedule to determine it. Okay, so hopefully you followed me on all of those points, and if you have any kind of questions, please post them to the discussion board.